Hey guys, it's Nick. So today the Fed raised rates by 3/4 of a percentage point, which is the biggest hike since 1994. And they said that they are strongly committed to fighting inflation. Really? Where were they for the last year and a half? So, how much more will they raise, and why is the stock market up and bond yields down on this news? Let's take a look. So the Fed raised its benchmark rate by 75 basis points to a range of 1.5 to 1.75, in line with investors and economists' expectations. So, who are these economists that are expecting 1.75% Fed funds rate while we have an 8.6% inflation rate, which means we have about a negative 7% real rate? And the Kansas City Fed dissented. He wanted a 50 basis point hike. And so here the Fed says they are strongly committed to returning inflation to its 2% objective. How are they going to do that exactly? And that's a change from their last statement where they said they expect inflation to return to 2% objective and the labor market to remain strong. So I guess they're not expecting this part anymore. So here's the real reason why the stock market is down. They reiterate their path on balance sheet reduction that took effect June 1st, shrinking bond portfolio by 47.5 billion a month and stepping up to 95 billion in September. In other words, instead of buying up all these bonds and supporting the market, they're now doing the opposite. And the market obviously doesn't like that. And so the market is just waiting for more bad news or an interest rate hike just so that they could say, okay, you did it. We're in a recession. Now let's go back to easing rates and buying back bonds and supporting the stock market and keep printing money up to infinity. So this is the plot of the Fed members' projections of where interest rates are going to be. And they increased a lot from March, rising to 3.4% by the year end, implying another 1.75 percentage points of tightening this year and getting to 3.8% in 2023, but then falling to 3.4% in 2024. And so the prior forecasts in March were for 1.9% rate increase this year and 2.8% in 2023 and 2024. And so if you want to know why they did 3/4 of a point and not half a point this meeting, let's take a look at this chart since the last Fed meeting. And you see here is when this last CPI number came out around June 9th and how everything reacted since then. And so NASDAQ is down 15% since the last Fed meeting. Treasury yields are higher, gold is down, and the dollar is stronger. And so look at how the Fed rate hike expectations have changed since that CPI number came out, from about 2.75 to like 3.7. And so the market is pricing 100% odds of the 3/4 today and 100% odds of 3/4 in July, and a 40% chance of 3/4 more in September. Now, that is likely to change if more bad CPI numbers come out. So, why did the stock market rise after the Fed raised interest rates today? Maybe it has a lot to do with the Atlanta Fed slashing second quarter GDP forecast to 0, confirming technical recession. So the Atlanta Fed slashed its forecast for second quarter GDP growth from 0.9% to exactly 0.0%, meaning the US is now on the verge of a technical recession. Curiously enough, why didn't they lower it to minus 0.1% or something? They stopped at exactly 0%, right? Now, don't assume that that growth is just going to magically stop at 0% because the Atlanta Fed said so. Because it's been cut from 1.9% on May 27th down to 1.3% on June 1st, and then down to 0.9% on June 6th, and just now down to 0. Wait a week and it's going to be negative. So here's a chart of the Atlanta Fed GDP estimate, and you see it was over 2% by May 3rd. And now it's straight down, magically stopping at 0 for now. So the Atlanta Fed is saying the second quarter real personal consumption expenditures growth, second quarter real gross private domestic investment growth, and second quarter real government spending growth decreased from 3.7 to 2.6, minus 8.5 to minus 9.2, and 1.3 to 0.9% respectively. In other words, the US consumer is getting tapped out. And that agrees with JP Morgan CEO Jamie Dimon, who recently downgraded the economy from storm clouds to hurricane. And so here's the Atlanta Fed's GDP forecast going down, but the University of Michigan expected change in prices during the next year going up. And there you have your stagflation. So this is what Wall Street is hoping for, that the Fed raises rates a few times, brings us into recession quickly, and then they have to change course and say, we can't do quantitative tightening anymore. We have to do quantitative easing. And so just print more money, lower interest rates, and get back to the party. Just to give you some perspective of where we were 41 years ago when we had the same CPI, 8.6%, the Fed funds rate was at 20.61. That's exactly 41 years ago, June 15th. And here we are patting ourselves on the back for a 0.75% interest rate rise by the Fed. So it seems this knee-jerk reaction of the stock market is likely a relief rally, and people will sober up when the next CPI comes out and they realize that the Fed is doing too little, too late. The real hope is that the Fed tightening pushes us into a recession quickly so that Wall Street can pressure the Fed to get back to printing money, lowering interest rates, and buying back bonds again instead of selling them. How many more times can they do this until we have hyperinflation? I don't know, but it seems they would rather extend the free money party for as long as they can rather than take their medicine now. Kind of like children. Hope you like this video. I'll see you in the next one. Thanks for watching, guys.